Central banks are typically seen as conservative institutions. Yet, when the tides turn and chips are down, world looks at them for support. This was the statement by RBI Governor Shaktikant Das when he recently announced Monetary Policy Committee's review and RBI steps to fight coronavirus. So what are these steps that RBI has taken to fight and give growth to India? What are the arsenals that RBI has got which can fuel growth? To know all this, stay tuned till the end of this video.
I never made it, but I know what it takes. I'm motivated by a mix of emotion. Got my statement.
Welcome back, Introspectors. Welcome to part 3 of our series where we are trying to decode what India is doing to fight coronavirus battle on economic front. In this video, we'll be talking about steps taken by Reserve Bank of India to keep financial system and financial markets sound, liquid and smoothly working. So I'm sure all of you remember that Government of India has announced a total package of 20 lakh crores. In our first video, we talked about Pradhan Mantri Garib Kalyan Yojana totaling up to 1.7 lakh crores. In the description below, you can find link to this video. In this video, we'll be talking about package announced by Reserve Bank of India. This package totals up to 5 to 7 lakh crores. We will not just be talking about what RBI has done, but also the tools that RBI has utilized to provide this amount of liquidity to the market. So all the measures that have been announced by Reserve Bank of India can be put in two broad buckets. First is liquidity measures and second one is regulations and supervisions. So in this video, we are going to talk about both and what RBI has done in each. So first we are going to talk about liquidity measures. Within liquidity, we are first going to talk about repo rate. Repo rate or term rate is considered to be the most important arsenal with RBI. To fight coronavirus situation, RBI reduced repo rate from 5.15% to 4.4%, which was a reduction of 75 basis points. 1 basis point is 1/100%. Now recently, RBI has further reduced it from 4.4% to 4%. But what is this repo rate? Why is it so important? Repo rate or repurchase rate is the interest rate that bank has to pay if they have to take money from RBI on short-term basis. Usually the duration for repo rate is between 7 to 28 days. In order to take this money from Reserve Bank of India, banks also have to give some kind of collateral. This collateral is usually government securities. So banks, they approach RBI, they give these government securities as collateral, they take the money from RBI and then with a promise that they are going to give the money back and buy those government securities from Reserve Bank of India. That is how repo rate works. How this repo rate impacts all of us. Whenever Reserve Bank of India increases repo rate, usually interest rate on our loans starts increasing. On the other side, if Reserve Bank of India decreases repo rate, we have a huge relief in terms of interest payments. Now assume yourself to be a bank. For a bank, giving loan to people is the best revenue generation. That is even the most important function of a bank. So if I have people available in the market who want to take a loan and they are credit worthy, that is, they can pay the money back, I would with all my interest like to give them the money. But then RBI is there. RBI, being the regulator of this sector, puts some kind of limits on banks to give money to consumers. The reason, they want banks to be sustainable. They do not want that someday, because there are some kind of non-repayments, banks falter. that will be a huge blow to the entire economy. So they put some restrictions on banks that how much they can pay. And they also put some restrictions that how much of the total money they have to keep in form of cash, which is always available with them in case of any emergency. So if bank is unable to meet any such regulatory guidelines or has some kind of requirement of cash to give to consumers on a very short term basis, they can go to Reserve Bank of India for this repo facility. Now, if RBI increases the repo rate, I as bank would feel difficult to take this loan. The reason? The money has become costly. Probably if I have to take 100 crores and earlier RBI was charging 5% interest rate, but now it has increased to 6%, it is becoming difficult for me to take that money, and that decreases the supply of money in the overall economy. When supply of money decreases in the economy, it leads to decrease in inflation. On the other hand, if RBI decreases the repo rate, it incentivizes the banks to take more money from RBI, increases the money supply in the economy, and that pushes the growth as well as in some cases inflation. To know more about inflation, I am putting link of my website in the description where inflation as a concept has been discussed in detail. To understand this phenomenon, let us briefly also talk about how banks calculate the interest rate at which they should lend you money. So for banks, the first and the primary component is repo rate. This is the rate or cost at which money is available to banks. On this, then they apply all the cost elements that a bank has got, such as manpower, providing IT infrastructure, etc. So all these costs become the second component. And third is the margin that banks need to be sustainable in the business. So these three components together provides an interest rate for every consumer. Third being very subjective and also depends on the credit worthiness of someone who is taking the loan. So whenever repo rate, which is the first term that determines interest rate, goes up, it directly increases the cost of money for bank, and that is why interest rates for end consumer increases. Whereas if repo rate goes down, it provides a relief to banks that they can take more money from RBI and lend it to the final consumer at a lower cost, so they also pass on the benefit to end consumer and interest rates decrease. So that is how a repo rate exactly works. Now when RBI has decreased repo rate from 5.15 to 4% to fight coronavirus situation, they are just trying to improve liquidity in the market. They are trying that people take more loans and banks agree to provide those loans at cheaper costs. Now talking about the second big announcement by RBI under liquidity measures. Earlier, reverse repo rate was at 4.9%. From 4.9%, RBI reduced it to 4%, which was a straight reduction of 90 basis points. Then it announced again another reduction from 4% to 3.7%, and recently it has further cut it down to 3.35%. So what exactly is reverse repo rate and why RBI is continuously reducing this rate? Reverse repo rate is exact opposite of repo rate. We define repo rate as the cost that banks have to pay to Reserve Bank of India for taking money on short-term basis. Similarly, reverse repo rate is the money that RBI has to pay to banks if it needs money on a short-term basis, or banks park some extra funds with RBI for a short-term basis. So in both the cases, this is the interest that RBI pays to banks. Obviously, when Reserve Bank of India is defining both, it will keep its cost lower than what it is making from banks. So usually reverse repo rate is less than repo rate. Now talking about what RBI is doing here and why it is continuously reducing it. Reverse repo rate is benchmarked to repo rate. So whenever RBI announces any change in repo rate, which usually happens bi-monthly, it announces that what is the repo rate, and then reverse repo rate is fixed as a spread to repo rate. Just to give it an example, if RBI says that repo rate is 4.9% and spread between repo rate and reverse repo rate is, let's say, 25 basis points. So reverse repo rate automatically becomes 4.65%. So in this case, what RBI is doing, that it is continuously increasing the spread. Earlier this spread was 25 basis points. So reverse repo rate was 25 basis points less than repo rate. But now it has increased the spread from 25 basis points to 65 basis points. What RBI is trying to achieve by increasing this spread is that it is continuously disincentivizing banks to park any additional funds with RBI. In this video, we have talked about RBI measures to save the economy from negative impact of coronavirus. Broadly, these measures have been clubbed under liquidity measures and regulations and supervisions. Under liquidity measures, specifically in this video, we have talked on repo rate and reverse repo rate, what exactly these two instruments mean and what RBI has done. For repo rate, RBI has reduced it from 5.15% to 4%, whereas reverse repo rate has been reduced from 4.9% to 3.35%. So currently, reverse repo rate is at a spread of 65 basis points from repo rate. Primarily, these measures are targeting liquidity and want to reduce cost of debt for the end consumer. In the next video, we will be talking about marginal standing facility, cash reserve ratio and TLTRO done by RBI to further ease out liquidity into the market. If you enjoyed this video, don't forget to like, comment and subscribe.